Everybody on Wall Street watches the Dow, the S&P, and the NASDAQ, but retirees shouldn't be watching those indexes, says my next guest, Chuck Widger from Brinker Capital. He's here to tell us why. Welcome, Chuck.
Thanks for having me.
All right, those are historical benchmarks. What's wrong with them?
Well, the problem is they don't work. And they don't work because when the volatility hits the fan, if you're investing in the S&P, you wind up running for cash. And then when the market recovers, you lose out on the recovery. It doesn't work.
All right, so what would work better? You talk about personal benchmarks at Brinker Capital. Can you explain that?
Well, I think the industry needs to redefine its valuation proposition, its value proposition. And I think the value proposition needs to be personally oriented rather than provider oriented. We need to focus on the investor's goals and make sure we construct portfolio strategies which are going to achieve those goals.
So if you're a retiree and you were going to sit down with that retiree, how would you lead them through their own personal benchmark?
It's interesting. Today, people really operate when dealing with numerical activities through mental accounting. It's a behavioral finance concept. And in mental accounting, we naturally separate our money into a checking account or a savings account or an investment account. So we create buckets. Similarly, with your investment dollars, I think you can create buckets and explain to an investor you're going to be in safety, income, tactical, and accumulation, and then balance between those buckets based on the investor's dominant objective, and then stick to your discipline once you've got it in place.
One big worries of retirees, of course, is inflation, keeping up with inflation. How do you arrange those buckets to make sure they keep up with the CPI? Because a lot of people don't think the CPI is correctly reflects inflation.
Well, one thing you want to do is to have some money in your accumulation bucket. And if you implement it with a good multi-asset class strategy, you should outperform CPI by 3–4% over a reasonable period of time. And that's what's great about personal benchmark investing. You're focused on creating purchasing power. You want to be able to spend in the future at the same level or even with more money than you do today.
I want to stay on this idea about inflation because it's very worrisome for retirees, even though people don't think it exists in the system, even though we know it does because healthcare costs are rising. Are you a fan of tips to keep up with inflation?
Certainly tips are one tool you can use in your fixed income allocation to keep up with inflation. But there are other strategies which can also enable you to accumulate more purchasing power over time. Tips has a safety feature, but good growth stocks or good value strategy in your accumulation bucket or real estate in your accumulation bucket can help you hedge against inflation as well.
What's very hard right now for retirees is they're not getting money at the bank because Ben Bernanke's keeping rates artificially low. So how are you advising them on this score? What are you telling them to do? Buy high yield munis? How do they get in the yields?
Well, clearly we have financial repression going on with the Fed's suppression of interest rates, so you aren't getting a good return on your money in the bank. In your fixed income allocation, you can choose a variety of fixed income strategies which are going to give you the yield you seek. For example, there are mortgage products in the marketplace that may have a 6% coupon on them. Or there are other securities or managers which similarly have a fixed income portfolio that will grab for yield, and you don't have to go to the high yield for all of your fixed income performance.
All right, thanks a lot.
Greg, thanks for having me.
Thank you for watching The Street.